Your take on the strength?
Yeah, I mean, I think, yields kind of letting up on the pressure a little bit, lifting a bit. You actually could look at it intraday. Just before noon, Treasury yields on the 10-year kind of dipped below 159. That was the top in the S&P for the day. And then yields went back up again, and the market kind of closed closer to the high. So that makes sense in the short term. I do think ultimately down the road, you'd love to see if stocks have the ability to rally in the same day that bonds are rallying and yields are going down. But we're not there yet. Right now, it's fine, I think, to just say oversold market. People got way too negative, started to extrapolate everything last week from zero rates in the U.S. to a recession, and now we're just easing up a little bit on that. But we're, to your point, though, about whether it's a bounce or not, we're not yet at that level where it's going to decide that. I would say another 0.5% up from here in the S&P, it's going to tell you if it's a bounce or more.
Is it, Liz, as simple as bonds up, yields up, stocks up, yields down, stocks down? That's the game we're playing right now?
I think going back to your earlier point, we're questioning whether or not this is real, if this bounce is real. You could also question last week if the inversion was real and if the fear was real. And it turned out it wasn't really. And it was only one day that we got really scared and then we were kind of over it. So everybody that's trying to time the markets intraday and trying to time the markets even on a weekly or monthly basis, just stop. It's not a winning game. And you have to continue to have that long-term view. We still think that there's a lot to be excited about.
I feel like it's a good time to have a debate about what's working and the positives and what's not working. And that's what people are doing. There's the recessionistas who are saying, look at the new orders in manufacturing, look at the bond market, look at the commodities. I mean, the CRB's off, almost 20% from recent highs. And then those that are more positive are saying, look at the fundamentals in the economy. Look at Walmart earnings, retail sales. Would you really have the consumer so strong if we were heading into recession?
I think a lot of those things can be true at the same time. And I think there's also a lot of room between we have an accelerating economy above 3% and we're dipping into recession. A slow, ambiguous picture is where we've been for a lot of this whole bull market.
I mean, we were having this debate last December, remember, Scott, when stocks were tanking. So where does the bond guy fall in?
So the bond guy falls. I think Liz had it right, basically. There was a little bit too much worry last week. There's a little bit too much worry in the markets right now. But some degree of worry is probably warranted. So we'd probably put it at about a 1 in 3 chance of a recession over the next 12 months. But it's by no means a foregone conclusion. We believe the ball is still in the Fed's course. We believe there's still enough time for the Fed to do something to adjust their course correctly. The ball's in their court, and they can maintain this economic expansion with the right monetary policy. But they've been behind the curve for a while, and they need to at some point get ahead of that curve.
You think we bottomed on yields? We bottomed out?
So our official call for the end of the year is 1 1/4 on 10-year yields. But basically, we think in this range, we're probably finding a bottom. Right now, if you look at where CPI is, core CPI, and where the 10-year is, the 10-year Treasury is almost 60 basis points below core CPI. Historically, that's been a level that is extreme valuation. We do think probably CPI will dip to meet that. But in this range, you should probably find some support for Treasuries, we believe.